Natural gas prices started Friday on a weaker note, weighed down by a bearish EIA storage report and forecasts of mild weather heading into early February. However, midday updates hinted at a potential shift, with colder air possibly sweeping across the northern U.S. between February 5 to 7, sparking a late-session rally. Despite ongoing inconsistencies in weather models, traders are closely monitoring the colder trends. If they materialize, they could support robust heating demand and influence market momentum. Most weather data points to a milder start to February across the southern and eastern U.S. However, there's also been talk of colder air possibly sweeping into the northern U.S. around February 5 to 7, though the models haven't been consistent. It's shaping up to be another risky weekend for holding positions, with the market likely hinging on whether February 4 to 10 trends colder or warmer. Meanwhile, analysts are projecting a significant withdrawal exceeding 300 BCF in the next report. Such a reduction could push storage from a slight surplus into a deficit near 100 billion cubic feet, creating additional upward pressure on prices if weather trends colder. Nevertheless, the next three storage reports are anticipated to align closely with seasonal averages, which could help ease some of the recent upward momentum in the natural gas market. It seems like the winter excitement is winding down, and with it, the focus is shifting to warmer temperatures in the U.S., which adds downward pressure on natural gas prices. As spring approaches, an early onset of warmer weather could trigger a significant drop in natural gas prices, potentially pushing them toward the $3 level. This shift would reflect reduced heating demand and the market's transition into the shoulder season, where milder temperatures typically curb consumption. However, the European market remains a wild card. European natural gas prices are still elevated, with the Dutch TTF benchmark hovering around €49 per megawatt-hour after briefly hitting €50 earlier this week. Concerns about low storage levels and heavy reliance on LNG imports are keeping prices supported, even with a small dip on Friday. European storage is currently at 57% capacity, significantly below last year's 74% and the 5-year average of 66%. The European market remains tight, grappling with reduced Russian pipeline supplies and rising LNG demand. This global LNG demand continues to bolster U.S. feed gas levels, helping to offset some of the production recovery after recent freeze-offs. Natural gas futures are gearing up for potential volatility as we head into next week. If colder weather patterns for early February become more consistent, prices could gain additional upward momentum, particularly with an anticipated large storage draw providing further support. I expect we may see another impulsive rally at some point within the next week or two. However, beyond this period, the focus will likely shift to the impact of warmer temperatures, which could begin to weigh heavily on the market. Should prices fall below the $3.50 mark, it could trigger a more extended decline, with the next key support level around $3.20. Without a substantial increase in weather-driven demand or a meaningful tightening of supply, the market's overall trajectory appears set to remain bearish in the weeks ahead. Traders should be prepared for both short-term spikes and longer-term downward pressure as these dynamics play out. This trend could persist until the new LNG export plants are operational later this year. Please like, subscribe, and comment to support the channel. See you in the next one.